Hi all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM level 2 and it's from paper 3, that is operational risk. And name of the chapter, the topic is from chapter solvency, liquidity and other regulation after the global financial crisis. So we will have a look at one of the numerical in which we will cover how can you calculate market risk capital charge for given details. So yeah, before we go ahead, please do subscribe to our channel. It takes a lot of efforts by our team to come up with videos like this. So this is a question. So there is a risk manager of FlexCity Bank. So Betty is asked to calculate market risk capital requirement for bank trading book. So according to their book, the 95% one day VAR. So let me just highlight key information because these are the few traps where you may get trapped. So the given detail is 95% one day VAR and which is $65,000 and the average for 95% one day VAR. So again, it's 95% and one day. Why I am emphasizing on these details because I'll just when I'll walk you through the formula, you will come to know. So when we need a 60-day average, so that's perfectly fine. No trap on that. And it's 27,000. And for stressed where we are, so basically just to give you more background about it, when you are given just war details, it's just, I mean, earlier it was based on 1996 amendment, which gave you the formula for market risk capital requirement. Whereas after global financial crisis, as per Basel 2.5, you have to consider stressed VaR also in your calculations. So in this numerical, we will use Basel 2.5 method to calculate market risk capital charge. So it's 95% one day stress VaR is $205,000 and 95% one day stress for again see everywhere is 95% one day. So I'll just round this information one again and again because this is the only key information that we need to factor in our calculation and rest should come along. So last 60 days, so stress for average for last 60 days is 85,000. So this if I were to give this as one, this is for normal VAR and this information one day and average are for stress time. So these are two informations we have been given and we have been told that multiplication factors for normal scenario and stress scenario are three. So she assumes the return on bank's trading portfolio normally distributed because of course you have to use corresponding Z values. So that's why it's important that your distribution is normal. So that's what you have been given or assumed. What is the nearest market capital requirement? So basically you have been asked to calculate market risk capital. So these are the four options we will explore. I mean, how the calculations are performed. So formula, before we start, I'll just give you the formula that we are going to use. So it's a maximum of previous day PAR or I mean, if I just tell this component as A and this component the multiplicative factor times average VAR as B. So whichever is higher between these two would be outcome of this max function. Likewise, same is applicable for stressed VAR. So stressed VAR for prior day or stressed VAR average over 60 days times your multiplicative factor. So whichever is higher of these two. So if I call this as X and if I call this as Y, so whichever is higher would be outcome of this expression, and so whatever is outcome of this expression plus whatever is outcome of this expression would give you the total market risk capital requirement uh, as per Basel 2.5. But very important point to note over here is that this VAR T minus 1 and average are 10-day 99% confidence. So everywhere I have underlined it. So it's 10-day and the confidence level has to be 99%. Whereas in the given question, it's 1 day 95% confidence interval. So this conversion from 1 day to 10-day and 95% confidence to 99% confidence is the only key that you have to take into account. Otherwise, it's just a direct plug and play kind of numerical. But yeah, I mean, in exam, usually you when you are under pressure of time, then we may end up missing these kind of details. So please be focused on such kind of details in your exam. And to convert, like as I said, that we need 10-day VAR, not 1-day VAR. So we need to multiply it with root 10. So in general, if I have to convert 50-day VAR, it has to be root 50. So it's 10 days, so it would be root 10, but I have given you the general formula. And another important from your FRM level 1, that's why we will emphasize that when you are appearing for FRM level 1, don't just run behind solving the problems, but understand what are the things that you may need for your level 2 preparation. So this is also one of the small information that we need from your level 1. So this says that if you were to convert any value from say X. So in our example, if I were to call it as 99% confidence level upon 95% confidence level, this would be equal to Z value of 99% over Z value of 95% confidence level. So we have been given 95% confidence level. We know Z values. We'll just multiply a 95 percentile value with this fraction and we will get 99% value. So these are the two key informations that you have to take into account. So I'll just mark it as star, or I will call this as a important slide, or these two formulas are important. If you understand these three formula, other slides should be just very easy for you. So what we have been given is 1 day 95% VAR for normal VAR, that is not stress scenario. I have for sake of simplification, simplified calculation, we have taken this as 1,000. So we were given 65,000. I have taken as 65, 27 instead of 27,000, and 3 multiplicative factor is 3. And this is for normal scenario. We have been given 1 day VAR 95%, and 1 day VAR, 1 day 95% VAR for stress scenario. We have been given as 205,000 and 85,000. We saw in the question. Again, multiplicative factor for stress scenario is also 3. So we will use that as 3. So now let's see how do we convert this 1 day 95% VAR to 10-day 99% VAR. So we will just multiply 65 for 10 days. We would multiply with root 10, and to convert it from 95% to 99% confidence, we will just divide that by fraction. That was Z factor of 99% confidence level over Z factor of 95% confidence level, which are 2.33 and 1.65 respectively. So we will just multiply with this fraction. And likewise, for this stress VAR, same logic, we will multiply 205 with root 10 and multiply with this fraction. So it's multiplication with root 10 and the fraction that we talked about in the previous slide. So these are the calculations that you have to perform on all these four numbers, and multiplicative factors, it will remain same as it is. So let's see what we get. So when you perform this calculation, you will get this previous day VaR. So it's now 10-day 99% VAR. So it's not now 290 approximately, and 60-day average for normal scenario, it's 120. And likewise for stress scenario, it's 915 and 379. So now we have got 10 days 99% VAR. Now we can use that formula for market risk capital charge directly. So let's see. So calculation is like this was from your previous slide, what we just obtained from previous slide. And formula for market risk capital charge is max of this expression plus max of this expression. So normal scenario and stress scenario. So if I were to just label this few details, so if I call this as 1, this as 2, and this stress previous day VAR as 3, and this average VAR as 4. So from this table, this is 1, this is your second, and this is your 3 and your 4. I'm not deliberately labeling this multiplicative factors because in both cases it's 3. So let's see, these will be substituted. So it's 290 comma 3 times your 125.57, likewise 915.43 comma 3 into this 3 is 979.57. So just simplifying further, so what we get is around 1500. But now as we saw that this number we had taken into 1000 instead of 65,000, we just took 65. So this number is in 1000, so 1500,000. So if I convert that 1500,000 into a dollar amount, it would be 1.5 million, which is our market risk capital requirement, which we were asked in the original question. So correct answer for this question is answer D, that is $1.5 million. Hope you like the video. If yes, please do share with your friends, peers who are appearing for FRM level 2 exam, and in general also people who are planning to make their career in risk management. This video might be very useful because it's eventually practically used as per the recent Basel norms. So please do share, comment if you have any doubts, and yes, thank you for staying till the end of video. And yes, at our institute, we stimulate thought process to enhance your learning. So we make you think instead of just training you for the calculation. So over here, we try to stimulate your thought process. So please do subscribe to our channel. Once again, it's a request for you. Thank you.